Welcome to Founder Files, the podcast for growth-minded leaders, investors, and operators shaping the future of business. Each episode dives into the critical decisions behind scaling, from finance and fundraising to leadership, strategy, and technology. Founder Files is powered by Cypher, the AI-powered and human-led finance partner helping growing companies scale with clarity and confidence. Learn more at cypherfin.com. Hello and welcome to Founder Files. Today we're going to discuss the top 8 questions I get from founders and CEOs about fractional CFOs, what they actually do, and when a company needs one. Hi, I'm Salma Hatim, founder and CEO at Cypher, where we work with growth stage companies to build and scale their accounting and finance functions. So let's start with question 1. If my books are clean and taxes are filed, what's the gap a CFO actually fills that I won't see on a P&L or tax return? So if your books are clean, processes are top-notch, controllership is well done, and compliance is taken care of, the missing piece may be cash flow management and FP&A. It's the transformation of your historical data into actionable business intelligence. You're moving from looking at what already happened into a more forward-looking finance function. That shows up in a few areas. Your forward-looking financial planning could be one of the first ones. Rolling forecasts, scenario planning, and asking yourself for what if this happened or that happened in my business, basically considering different scenarios and projecting those scenarios and seeing the impact in your business and making decisions based on that. Capital allocation is the second one. How do you optimize the mix of debt, equity, and retained earnings to fund growth? Instead of just using whatever cash is available in your business and just using it for overhead, you could be using it for things that could create additional ROI. A third one could be cash flow optimization. How do you manage your working capital, your runway, your pricing, margins, your vendor terms in order to optimize your cash and use it effectively and never run out of it? It also includes how you measure and manage the business. What are your KPIs and what type of decisions do they drive for you? So it's important to start thinking about building custom financial and non-financial metrics that are tailored to your business model and your industry and that actually help you make decisions. Another factor that you could think of in addition to just having clean books, processes, and controllership is your risk mitigation and internal controls. Once you reach a certain level of growth, you want to think about fraud prevention, process improvements, and making sure your financials are audit ready or due diligence ready if you have especially if you have a major event coming up. So in short, if we were to give broad definitions. Your bookkeeper is there to record the data. Your CPA handles your compliance, and your CFO will allocate the additional resources to fill in the gaps we just mentioned and interprets that data to drive decisions, growth, and improve liquidity. So your CFO can also help you manage all of these layers of the finance function. So you're not just spending time and managing multiple people across accounting and finance. I hope that was helpful. Let's go to the second question. What are the first symptoms that feel like ops or sales problems, but are actually CFO problems? So here's the thing. Sales, ops, and finance are very interconnected. So problems in one area often show up in another. What looks like ops issue or a sales issue is often a direct impact in how information flows into finance. A CFO improves that flow across teams. So let's give an example from sales to finance. We've had, for example, to train sales teams on how to enter contracts properly into a CRM. So accounting can use that data for invoicing and revenue recognition properly. If contracts, for example, are too customized and too controlled by the sales team without a specific process, and if that underlying data is unclear, that creates issues downstream in billing and reporting. And also revenue recognition, which is a really important one and could very much impact reporting. That's an example of an issue that could happen if the flow is not thought through between sales and finance. Let's give another example from ops to finance. Processes around AP, AR, inventory, and payroll could directly impact accuracy, fraud risk, and reporting quality. Let's say your inventory management is not done properly. That could lead in wrong inventory balances on your balance sheet, and that could usually just come from your warehouse and could not be your accounting team's fault, but a process issue and a process gap. So it's really important to look at these flows and these controls in order to have a proper accounting and finance function. Okay, let's move on to the third question. What's the simplest way to audit if I have bookkeeping or if I actually have a finance function? So if you want a simple way to tell it whether you only have bookkeeping or you actually have a full finance function is looking at what your finance team actually does and what value you gain from it. If it's only recording transactions, reconciling accounts, producing basic reports, then you probably have bookkeeping. A real finance function has additional layers, strong processes that produce accurate data, proper accounting, and GAAP compliant reporting. It's usually audit ready and M&A ready. It would also include your cash flow management to be complete, your forward-looking FP&A to drive better business decisions. I mean, most companies stop at bookkeeping, which is unfortunate, and they never really build those additional layers. But it's if you have very specific goals in mind, especially are looking to grow over time, these layers are really important to look into and to implement in your business. Question 4. When are you too big for just a bookkeeper plus CPA setup? So basically, this is asking, when do you outgrow your bookkeeper and CPA, bookkeeper recording your transactions and CPA doing your compliance? So honestly, I would say there's no specific number, especially revenue number. It depends really on the complexity of the business and the events and goals. It usually comes down to what's your transaction volume, how many scenarios are you managing, whether your numbers are being reviewed by investors, lenders, or banks, whether they are being audited. One misconception is that I see founders often think that they need a fractional CFO right away, which can be very costly. In my opinion, unless you have a business event or transaction like a capital raise requiring a financial model or financials that are very specifically requested by investors, in your early stages, you should focus on setting up bookkeeping properly first, building processes, delegating execution. And as the CEO, you need to focus your time on strategy and not delegate that too early. So you can seek advice for sure, but not entirely delegate your vision and your strategy, which is a common mistake I see with CEOs wanting to hire a fractional CFO too early on to delegate that strategy. But in my opinion, that is not the right way to go about it. As the business grows, you'll get more transactions, you'll get more decisions, you'll get more pressure on your cash flow, and that's when a CFO becomes necessary. The ideal setup is to find an outsourced team that can cover both bookkeeping, controllership, and CFO level expertise. That way, you can start with bookkeeping at a lower cost, implement strong processes with their help. They get to know your business and your industry really well, and then they grow with you and can help you layer in a senior finance support when it actually becomes necessary for you. So instead of bringing in a CFO before the business requires it, this method allows your finance team to grow with you again and helps you avoid overspending on finance before it's actually necessary. If you were to ask me, I actually never push fractional CFO support upfront. I really recommend building a foundation first and then introducing controller and CFO support over time. Okay, let's go to question number 5. What are the specific triggers where you needed a fractional CFO 6 months ago? There are a few clear triggers. Let's name a few. Cash burn is becoming harder to manage. Maybe your billing is getting more complex. Your revenue recognition becomes confusing. Your inventory adds operational and financial complexity. And then maybe you have more strategic pressure that starts to build. You're preparing for a major event like fundraising, debt, or M&A. Your investors may be asking you questions, more detailed questions, that you need proper financial models and KPIs to answer those questions and to drive decisions under that scrutiny. Maybe also your capital structure is becoming more complex, whether that's debt or equity, and you need help managing that. Let's go to question number 6. What are the red flags that founders and CEOs are doing the CFO's job themselves? Oh my gosh. This one gets me every time and surprises me every time. One of the biggest red flags is still being involved as a CEO in reconciliations, in invoicing, in chasing payments, in managing vendor payments. These are small tasks that can easily be delegated and automated in certain cases. If you keep yourself too close in the weeds, you don't really zoom out and you don't really interpret your numbers properly. You don't really get to use them to make decisions, which is really what the value that numbers provide you as the CEO and the founder. I've seen this in companies doing over $10 million in revenue, where the CEO was still very much involved in the day-to-day accounting function. At that point, the founder or CEO is not really leveraging their accounting and finance team the way they should. And what I'm saying is that they could have a finance team, but still very much in their way, and that really makes you lose time and money. And yeah, you're not using your resources effectively, which could be a really big red flag in how you manage your business. Question number 7. What does a good fractional CFO setup look like versus hiring a full-time CFO? Okay, a full-time CFO is expensive. You're talking about a 6-figure salary plus benefits, bonuses, and overhead. A fractional CFO lets you pay for expertise when you actually need it, which is super convenient, especially for a growing company. Even companies over $10 million in revenue may not need a full-time CFO. In terms of how much you should pay a fractional CFO, it really depends on the stage you're in, the complexity of your business, and the expertise of the CFO. If you ask me, CFO support can start around $2,000 per month for a small scope of work tailored to only what you need. You can find that if you really took the time to find the right fit. In the market, a good fractional CFO typically ranges from about $5,000 up to $15,000 a month. Really, the goal is not to hire the highest level of support as early as possible. It's to bring in that level of expertise when the business actually needs it. So you want to really think about, cost versus benefit when making this decision. Okay, final question. Question number 8. What's the difference between a CFO and a controller? This is a really, really good question because this always gets mixed up. A controller focuses on historical data, cleanup, audit readiness, and making sure your financials are accurate and US GAAP compliant. A CFO focuses on forward-looking strategy, forecasting, planning, and decision-making. If your goal is audit-ready financials, you'll likely just need a controller. But if your main need is forward-looking planning, scenario modeling, and capital allocation to support growth, then you need a CFO. You shouldn't be paying for high-level CFO support if there are no forward-looking needs. If you're starting to see some of these patterns we just discussed today, that's usually when it makes sense to bring in the right level of finance support. And that's exactly how we think about it at Cypher. Thank you for watching and see you in the next episode.